There is a clause sitting inside your mortgage offer right now on a page most people never open past that can cost you tens of thousands of pounds the moment your circumstances change even slightly. Not if you miss a payment, not if you default, just if life happens. A job change, a house move, a decision to overpay while rates are high. Banks do not hide this clause. It is technically disclosed, but it is buried in language designed so that 98% of borrowers sign it without reading a single word of it. This video is not about whether mortgage rates are going up or down. This is about the paperwork sitting in your inbox right now, the paperwork you already signed years ago, and the specific sentences inside it that are quietly working against you. I have been tracking the UK property and mortgage market for years, and I want to walk you through exactly where these clauses live, what they actually say once you translate them out of bank language, and what they will cost you if you ignore them. By the end of this video, you will know exactly which page to open in your own mortgage offer and exactly what to look for. Let's start with the scale of this because it is bigger than most people assume. The vast majority of UK residential mortgages across every major lender contain some version of the clauses I am about to walk you through. This is not a shady lender problem. This is not a subprime problem. This is Halifax, Nationwide, Barclays, NatWest, Santander, the household names. The clauses are legal, they are enforceable, and they are written this way on purpose because a mortgage offer is a sales document first and a contract second. The friendly cover letter tells you your monthly payment and your interest rate. The actual terms and conditions booklet, sometimes running past 40 pages, is where the real mechanics live. Almost nobody reads that booklet cover to cover. Solicitors are meant to explain the key terms during conveyancing, but in practice, most conveyancing today is high volume and low touch. You get a phone call, a few bullet points, a signature request. The nuance gets lost, and the nuance is exactly where the cost is hiding. Let's go through the clauses one at a time. Clause 1, the early repayment charge trap. Most borrowers know that overpaying a fixed-rate mortgage can trigger a penalty. What most borrowers do not know is exactly how that penalty is calculated and how aggressively it scales. Standard practice allows you to overpay up to 10% of your outstanding balance per year without penalty. Go £1 over that 10% threshold, and the penalty is not calculated on the excess amount. In many mortgage contracts, it is calculated as a percentage of your entire remaining balance, sometimes as high as 5% in the early years of a fixed deal, stepping down gradually as the fix matures. On a £250,000 mortgage, breaching that threshold in year 1 can trigger a penalty north of £12,000 for overpaying by a few £1,000s too much. People who come into unexpected money, an inheritance, a bonus, a redundancy payout, and try to responsibly pay down their mortgage faster walk straight into this without any warning from their lender because the lender has no obligation to warn you in the moment. The obligation was satisfied years earlier in a booklet you signed and never opened again.
Clause 2, the material change of circumstances clause. This is the one almost nobody has heard of, and it is one of the most consequential. Buried in the general terms of most mortgage contracts is language giving the lender the right to review and in some cases reprice or even recall your mortgage if there is a material change in your financial circumstances or in the security of the property, meaning the property's value or condition. The word material is deliberately vague. It is not defined with a specific number or event. In practice, lenders rarely invoke this clause aggressively against ordinary residential borrowers who keep paying on time, but it exists, it is enforceable, and it has been invoked in cases involving job loss, a significant change in employment status, such as moving from employed to self-employed, and in a growing number of cases in 2026, cladding and building safety issues that affect a flat's value. If your lender decides your property's security has been materially affected, they can, under the terms you signed, adjust your terms, request additional security, or in extreme cases, call in the loan. This clause is why owners in buildings with cladding or fire safety issues have found their mortgage situation quietly deteriorating even while they continued making every payment on time. Clause 3, the revaluation on remortgage clause and the loan-to-value cliff edge it creates. Every time you remortgage, whether with your existing lender or a new one, the property gets revalued. Most borrowers assume this is a formality. It is not. If that revaluation comes back lower than expected, and average revaluations in 2026 are running meaningfully below what owners paid for their properties, particularly for flats, you can be pushed across a loan-to-value threshold without warning. Mortgage pricing works in bands. 60% loan-to-value gets you the best rate, 75% gets you a worse rate, 90%, if you can get it at all, gets you the worst rate on the table. A revaluation that drops your property value by just 10% can push you from a 75% band into an 85% band, and the rate difference between those bands can be well over a full percentage point. On a £250,000 mortgage, that is thousands of pounds a year for no reason other than a valuation, using a methodology you have no visibility into and no right to formally challenge in most cases. Clause 4. The porting clause that almost never works the way you think. Porting is marketed as flexibility, the ability to carry your existing mortgage rate over to a new property if you move house, avoiding early repayment charges. It sounds like a safety net. In practice, porting is not a guarantee, it is a reapplication. You have to pass full affordability and credit checks again at the point of the move under whatever criteria the lender is using at that time, not the criteria that applied when you first took out the mortgage. If your income has changed, if lending criteria have tightened, which they routinely do, or if the new property does not meet current valuation and security standards, porting can be refused. And here is the part almost nobody understands until it happens to them. If porting is refused, you do not get to simply keep your old deal on your old property. You are moving. The mortgage on the old property has to be redeemed. So refusal of porting often means paying the early repayment charge in full anyway, the exact cost the porting clause was supposed to protect you from, at the worst possible moment in the middle of a house move. Clause 5, the building's insurance and service charge default clause, and this one is specific to flats and leasehold properties. Most mortgage contracts contain a clause requiring you to maintain adequate buildings insurance and, for leasehold properties, to keep your service charge and ground rent payments current as a condition of the mortgage, separate from your actual monthly mortgage payment. Fall behind on service charges, and in the worst cases, the freeholder can apply for a charge against the property, known as a legal charge, essentially a claim on your home's equity for the unpaid amount. If that happens, you are technically in breach of your mortgage terms, even though every single mortgage payment has been made on time. Lenders can treat a legal charge from a freeholder as a default trigger under the mortgage conditions because it represents a competing claim against the security of their loan. This is precisely the mechanism behind a growing number of 2026 cases where flat owners, current on their mortgage in every sense a normal person would understand, find themselves formally in technical default because of a service charge dispute they may not have even known was escalating. Now here is the part that connects all 5 of these, and it is the part banks do not want you thinking about together. Every one of these clauses shares the same design feature. They shift risk from the lender to the borrower, at moments the borrower does not control and often cannot even see coming. A material change clause you can't predict, a revaluation methodology you can't challenge, a porting decision made under criteria you can't see in advance, a service charge dispute happening in a management company's office you have no visibility into. Individually, each clause is defensible. Lenders will tell you correctly that they need mechanisms to protect the security of the loan. But stacked together across an entire mortgage book of millions of borrowers, these clauses form a system where the lender is protected against nearly every conceivable form of risk, while the borrower absorbs risk from directions they were never warned to watch.
I spoke to a mortgage broker who has spent over a decade placing residential mortgages, and off the record, her view was blunt. She said the entire industry relies on borrowers signing a bundle of documents once, under time pressure during the most stressful and expensive weeks of buying a home, and then never opening those documents again for the life of the mortgage, which can be 25 or 30 years. She said the terms and conditions booklet is, in her words, the most important document nobody reads, and lenders know it, because if borrowers actually read it clause by clause before signing, completion rates would slow down, and lenders do not want that. So what do you actually do with this? Here is the practical playbook. First, find your original mortgage offer and terms and conditions booklet. If you cannot locate it, request a copy from your lender. You are entitled to one. Second, search that document specifically for the terms overpayment allowance, early repayment charge, material change, and default. Those 4 phrases will take you directly to the clauses that matter most. Third, if you are planning any lump sum overpayment above 10% of your balance in a given year, call your lender first and get written confirmation of the exact penalty before you send the money, not after. Fourth, if you live in a leasehold flat, treat your service charge account with the same seriousness as your mortgage payment, because your lender does. Set up a direct debit, keep records, and if a dispute arises with your freeholder, address it immediately rather than letting it sit. Fifth, before any remortgage or house move, ask your broker directly whether porting is realistic given your current circumstances, and get a second opinion on whether a full new application might actually be safer than relying on a port that could collapse mid-transaction. None of this is complicated once someone actually walks you through it. That is exactly the problem. Nobody walks most borrowers through it. You get a mortgage offer, a completion date, a set of keys, and a booklet that goes into a drawer. The clauses inside that booklet do not go away. They sit there, dormant for years, until a job changes, or a valuation comes in low, or a freeholder sends a letter, and suddenly a document you signed once in 15 minutes, under pressure years ago, is the thing deciding how much of your equity you keep.
Here is where this is heading. As the remortgage wall I have covered in previous videos continues through 2026 and into 2027, more borrowers are going to hit these clauses for the first time, not because they did anything wrong, but because more of them are moving between loan-to-value bands, more of them are facing service charge increases, and more of them are trying to overpay their way out of higher rates without understanding the penalty structure. Expect to see a rise in complaints to the Financial Ombudsman Service specifically about early repayment charges and porting refusals over the next 18 months. Expect consumer groups to push harder for standardized plain English mortgage summaries. And expect lenders to resist that push because ambiguity has always worked in their favor. If there is one thing I want you to take from this video, it is this. Your mortgage is not just your interest rate and your monthly payment. It is a 40-page contract that you agreed to once and are bound by for decades. The bank read every line of it before they sent it to you. Make sure you are the second person who does, not the first person who finds out what it says the hard way. Pull out that booklet this week. Read the 4 sections I mentioned. It will take you less than an hour, and unlike almost everything else in this market right now, it costs you nothing and it is entirely within your control.